Welcome to Law Easy. My name is Marty Schenkman, and I'm joined by Jonathan Blotmacher. And we have a really critical topic for this brief video on the Secure Act. The Secure Act was enacted in December 2019 and dramatically changed how many people will want to provide for beneficiary designations for retirement plans, qualified plans, IRAs. We may just refer to them as IRAs, but it applies to all. In general, what the Secure Act did was largely eliminate the ability to stretch out the payout from a retirement plan. So if a child inherited, in general, an IRA from, say, a parent, in general, they would be able to pull that IRA out over the child's life expectancy, which gave incredible tax deferral. And in many cases, great asset protection planning as well. And there was an incentive for the child not to pull the money out earlier because they would void or eliminate the wonderful tax benefits. Under current law, now post-Secure Act, that stretch IRA has largely been restricted or eliminated. Jonathan, do you want to comment on some of the ways the Secure Act restricted, and then what we'll try to do at the end is focus on some creative techniques that people might want to put into their toolkit for reclaiming the equivalent of a stretch?
Let me begin by pointing out that the ability to postpone taxation is the next best thing to avoiding taxation, which is the most powerful factor in all of financial planning, whether it's income tax planning, whether you're trying to build wealth, whether it's estate tax planning. Tax-free and next best tax-deferred compounding is the king and queen of that planning. And under prior law, when you named a beneficiary who would succeed to the interest in the plan or IRA, you could have the payments come out over his or her life expectancy. So a grandparent might name a very young grandchild who might be able to take out the payments over, say, a 65 or 70-year period of time, allowing the interest inside the plan or IRA to continue to build. That has been taken away by the Secure Act, except for 5 types of beneficiaries known as eligible designated beneficiaries, or EDBs. Those consist of the surviving spouse of the plan or IRA owner, and that continues, and that spouse's best thing from a tax perspective is to roll the interest over to his or her own IRA. They can delay taking it until their required beginning date and then take it over a recalculated life expectancy. Very, very powerful. Second is you can take it out over life expectancy, not recalculated, but the standard, if the beneficiary is disabled, which has the same meaning as it basically does for elder law purposes, or chronically ill. That person can take it over his or her unrecalculated life expectancy. Also, a minor child of the plan participant or IRA owner, not the minor child of someone else and not a minor grandchild, but a minor child of the plan participant or IRA owner can take it over the child's non-recalculated life expectancy until the child reaches majority, when they have to switch over to the 10-year rule, which we'll get to in just a moment. In addition, if you have someone who's not more than 10 years younger than the plan participant, she or he too can take it over his or her life expectancy. That's the basic rules. But if you don't fall in one of those 5 categories of eligible designated beneficiaries and you're just an individual, you have to take it over 10 years following the death of the plan participant or IRA owner. They can no longer stretch it over their lifetimes. One benefit of that is that they can wait until the end of the 10th year following the death of the IRA owner or plan participant and take it out. Whereas if you use a life expectancy, you have to take it out ratably beginning in the year after the plan participant or IRA owner dies. If you're not an eligible designated beneficiary, or just a designated beneficiary because you're not a human being and you don't fall under one of the special trust rules, then you have to take it out as a general rule over 5 years, unless the plan participant or IRA owner has reached his or her required beginning date, which is today is around age 72. So if you have somebody who is over the age of 72, then you don't use the 5-year rule. You use the balance of the plan participant's life expectancy. By the way, if you're under the age of 92, you will have more than 5 years. But unlike the normal 5-year rule where you can wait until the end of the 5 years, you have to take it out ratably over whatever remaining life expectancy the IRA owner or plan participant had.
So now with these changes, we have a different and a new environment. And there's a number of different factors, and we only have about 4 minutes left, so we can only briefly touch on them. But what we're going to do is introduce 3 creative planning techniques that you may want in your arsenal. But keep in mind, there's a number of factors that practitioners have to think about in guiding clients on how to set up a beneficiary designation. One is the question of income tax and being cautious and mindful of having a lot of money trapped inside of a trust at a high tax bracket. Another is the asset protection of having something owned outright without a trust. And a third is the sophistication or maturity of the beneficiary, which may create a problem. Jonathan, there's some background noise there that if you can
Yes,
silence.
continue to cut back on the background noise for a few minutes. Thank you.
Yeah, I'm sorry about that. Quarantine hazards, folks, so you all know about those. So there's 3 techniques that we want to quickly mention. One is naming a charitable remainder trust as a beneficiary. So the idea is that a charitable remainder trust is an entity that does not pay income tax. So what happens is if the IRA is paid to the CRT, the charitable remainder trust, there's no income tax on that pay in, but there'll be income tax on the payout to the beneficiary of the CRT. But that may give you the equivalent of a stretch over, say, 20 years or the life expectancy of the beneficiary, depending on how it's structured. So, Jonathan, do you want to comment quickly on CRTs, and then we'll go on to the other 2 techniques that we want to just alert people to?
But by the way, there's an article in the May issue of Estate Planning magazine that I did with my nephew and with Richard Fox, who's one of the outstanding charitable lawyers in the United States. And we talk about using charitable remainder trusts. And I think the best thing you can look at if you want a long stretch is an income only with makeup charitable remainder uni trust. Read the article. It can be a great idea for many of your clients, where you get the benefits of having a trust and you get the benefits of a very, very long period of time without taxation.
We only got 2 minutes, so let's give 1 minute to each of our other techniques. Another concept is a so-called beat it, beneficiary defective trust, a beneficiary defective irrevocable trust, as some call it. In the beat it, you can give a power to withdraw, a right to withdraw to the beneficiary, which makes the trust a grantor trust as to the beneficiary, so that all the income will be reported by the beneficiary, but the assets may be retained inside the trust. So beat it is another tool you may want to have in your planning arsenal if the clients don't qualify for any of the 5 exceptions that Jonathan talked about. You want to make a quick comment on beat its, and then we'll do the last one.
Yeah, the reason you want the beat it as opposed to a different type of trust, and understanding that if it's a beat it, you may be losing some creditor protection, is because if you make it payable to a trust that's not a grantor trust, it means it's going to be taxed at the trust very compressed brackets, where the trust will reach the top 37% federal income tax bracket at just $12,950 of income, whereas individuals don't reach that until they're well over $500,000. So we're trying to figure out ways in which we can have it go into trust, get some of the benefits of a trust, but yet not have to pay tax at the compressed trust rates. One of the other ways that
Jonathan,
yes.
We have 30 seconds. Tell everybody about a twist as a beneficiary.
Yeah, a qualified subchapter S trust may be the best thing to use for many, where you actually name the S corporation as the beneficiary of the qualified plan or IRA. There'll be an article coming out in the July issue of Estate Planning magazine, which will spell that out in detail. And Marty and I and others will be putting on a webinar about this in the near future.
And for that webinar, you can go to shankmanlaw.com webinars or interactivelegal.com's website or Peak Trust website. Thank you for joining us. Please bear in mind that all the video clips on this website, including this, are for educational purposes only. Don't take any legal action without appropriate guidance.